Nobody covers the Fed like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens as we continue to digest that exclusive interview with the Treasury Secretary Scott Bessent in the U.S. Heidi, he seemed to be pretty optimistic about bond market performance, not to mention the disinflationary trends that he sees coming from the Trump administration's policies.
Contrast, of course, when it comes to Japan, where we're seeing the strengthening of these inflationary trends, right? Really, as Garfield Reynolds said earlier, there's multiple green lights now in terms of how confidently the BOJ could progress from here.
Yeah, the Japanese yen at levels that we haven't seen since December. We're talking about strength against the U.S. dollar as yields also continue to rise. The 10-year yield at the highest level since 2009. And we have already heard from the finance minister, Katsunobu Kato, coming out talking about how debt servicing costs going up could actually have an impact on Japan's finances. We're seeing the Japanese yen pare back a little bit of that strength that we saw overnight. And this after the core CPI number surprised to the upside. A very strong 3.2% growth year on year, above economists' expectations. But at the same time, a lot of that potentially having been priced in, given that we are expecting food inflation, food prices to continue rising. The Nikkei down 0.4% early in the session. But take a look at how the Korean stock market is coming online as we're also getting those first 20 days of trade numbers for the month of February, surplus of $804 million. Of course, what we're watching, exports rising 16% year on year, imports rising 7.7% year on year. That's very interesting because we will continue to watch the export numbers for South Korea, bellwether for the rest of the world at a time when we, of course, do have the Trump tariff threats on everything from automakers to chip makers. And this, of course, a very important segment of the South Korean market. We're seeing the Korean won a little bit stronger at that 14.33 level against the U.S. dollar. Heidi.
Take a look at what we're watching when it comes to Australia, Sherry. Of course, it's been a difficult set of sessions so far this week when it comes to equity trading. This is a market that's coming off some recent record highs. So given we are in the thick of earnings season, given that a lot of those heavily weighted miners have seen pretty depressing numbers being announced this week, unsurprising that it has been a pretty subdued week. At the moment, though, we're seeing kind of the ASX 200 just keeping its head above water as we continue to hear from the RBA's Governor Bullock there, really talking at length about the labour market and really the way that it signals that stronger economy, also kind of balancing the rhetoric when it comes to the narrow path as they have started to cut rates this week and how they get that inflation within that target range sustainably. They've said that the bank is not committed to any kind of particular course of action when it comes to rates, given the evolving risks, of course, are many. This is a picture when it comes to Australian bonds trading at the moment, as well as energy prices as we continue to watch that sort of tug of war between supply and demand downside there. We are seeing the likeliness of a weekly advance there when it comes to crude. The supply uncertainty side of the picture is clouding the outlook, and we could see that biggest gain since early January. Well, US Treasury Secretary Scott Bessent says he's in no rush to boost the share of longer-term treasuries in government debt issuance. He also told Bloomberg that President Trump's policies, taken together, will not revive US price pressures.
Everything that President Trump's administration is doing will be disinflationary. We're going to bring down energy costs. We're going to bring down regulation. What DOGE is doing in terms of cost cutting. And I think once the Tax Cuts and Job Act is made permanent, then we can have a revenue increase, cost decrease. And as you said, as the nation's top bond salesman, I got a pretty good story.
Let's bring in Ron Tamble, Chief Market Strategist at Lazard. Ron, really great to have you with us, particularly here in the Sydney studio. Is it a compelling argument that, taken as a whole, President Trump's policies are not at all going to be inflationary?
I think when you deconstruct it and you go through the major pieces, more of the pieces are inflationary than disinflationary. So in particular, I focus on tariffs. Clearly, we've already got a 10% tariff on all Chinese exports to the U.S. that went into place on February 4th. We have a whole schedule of additional tariffs that the president has talked about. On March 4th, Mexico and Canada have the end of their 30-day grace period. March 12th, steel and aluminum tariffs. April 1st, reciprocal tariffs. April 1st, the Treasury, Commerce, U.S. Trade Rep and OMB have to release their report on global trade practices. And then we have April 2nd, the president has talked about tariffs on autos. Well, those all drive prices higher. And by the way, he's also talked about pharmaceuticals and semiconductors. So when you put those in context, it's hard to see how that could in any way be deflationary. And then if we add on some of the campaign promises around immigration enforcement, that's also likely to be inflationary. So it's not particularly compelling, at least on the surface, in my opinion.
I mean, April may as well be, 20 years away if you look at the sort of level of comfort that we see in markets, right? Do you think investors are being too complacent and being just happy to kick the can down the road?
I think there is a complacency, and it's actually something that worries me quite a bit, because when you look at equity market valuations with the S&P at 23 times forward earnings, with credit spreads at very tight levels, it is a market that's priced not for perfection, but for very good news in the future. And it does seem in my conversations with asset owners globally, most people, a substantial majority of people, believe that this is a negotiating position. It's bluster. Some people believe, it's for scoring political points. But I think the president and his team genuinely believe that the U.S. needs to reduce its trade deficit and that tariffs are an effective way to do that. So I guess I worry that people are not taking the president seriously or literally, and they should, because this has been a core conviction for many years for him and for members of his team.
And given all of those inflationary concerns, Ron, and the fact that we could see perhaps more moves towards safe havens, is that a given that we will see more strength for the U.S. dollar then?
Well, I'm never going to say it's a given, but that is my base case assumption. I mean, if we look at the likelihood of higher inflationary pressure from tariffs, additional inflationary pressure from immigration enforcement, and by the way, I should have mentioned, these are positives for the equity market. Deregulation, in theory, on the margin could add to growth. And if you have corporate tax cuts and the extension of personal tax cuts, those could add to growth. So all of that adds up to more inflation pressures. And that probably means, in my view, that the Fed is not going to cut rates at all this year. The market is saying 38 basis points of cuts by year end. I think that will be a zero. And to get to your question, if currencies are driven by changes in expectations of interest rate differentials, I know that's a mouthful, but changes in expectations of interest rate differentials, then that should mean a stronger dollar. And by the way, I would note the converse, or the flip side of that whole argument. If we do indeed impose tariffs, as I think the United States will, that probably means lower growth in other regions and more rate cuts from those regions. So where the market says the ECB will cut by 78 basis points by year end, I think that's probably 125 basis points. So I do expect more dollar strengthening in the months ahead.
So given what you're saying, if we're expecting more U.S. exceptionalism, whether it's a dollar, are we expecting that also for U.S. equity markets? And would you stay put, or would you try to use this time in order to reallocate your capital?
I think actually this year is going to be a great opportunity for investors to consider some pretty important reallocations. I do think the U.S. equity market can continue, I was going to say continue to outperform, but if you look year to date, the DAX has actually done quite a bit better than the S&P. The CAC has done better. But I do think you will see U.S. outperformance over the next several months, because the pain of tariffs is actually more significant on the countries outside the U.S. than it is to the U.S. And so I think you could see some outperformance there. And as I mentioned, I think you'll see a stronger dollar. But in my view, this is going to be a great opportunity to move capital out of U.S. equities into other regions. For example, I think Japan has a very good story. Obviously, we just got solid inflation numbers again this morning. I think you're going to get positive news out of the Shunto wage negotiations this spring. So I think Japan is one place people should be looking. I also think emerging markets ex-China could be a very good place to put money on a long-term view in terms of capital shifting away from China to avoid that geopolitical tension and looking for other low-cost places to manufacture. So I think that would be one choice. And then the other, by the way, is it's probably a good time to be on the margin, taking capital out of some of the high-flying tech stocks, the Mag 7 and friends, and moving down the cap spectrum as earnings growth broadens out in the U.S. this year into other sectors, and you get better performance beyond that very narrow group that led the market for the last 2 years.
Why ex-China? You take a look at Alibaba overnight. I mean, is China tech looks like it's back?
Now, the challenge with China, I think it's a market you can trade, but what I'm looking at here is a structural alpha story, in my view, of capital moving. You look at 3 of the last 6 quarters, foreign direct investment into China has been negative. If you look for the 15 years through 2021, 100% of FDI into emerging markets went into China. I think over the next 10 to 15 years, a substantial majority of that will go to EM ex-China. Now, the risk of my call on EM ex-China is exactly what you just said. You get these severe rallies. We saw this last year in February through May. September 23rd of last year, we saw this Chinese equity market rally over 30% in a short period of time. And I do recognize there are high expectations out of the National People's Congress, the 2 sessions in March. My worry is that the downside or the risk of an EM ex-China trade is you could miss a pretty big rally in Chinese equities, but my conviction is until China makes major structural reforms, those growth spurts are going to be short-lived, and you want to trade those rallies. It's a rent, don't own.
Ron Temple, Chief Market Strategist at Lazard. Always good to have you with us. In fact, we actually saw that pretty big rally, at least overnight, when it came to Alibaba. The U.S.-listed stock surging on their fastest pace of revenue growth in more than a year. Let's get more with our tech reporter, Annabelle Drulers. Annabelle, of course, there's a lot to unpack, but let's talk about their biggest and most important divisions.
Yeah, so there's the e-commerce side, and then there's also what they're doing in cloud. But I'll kick off with, I guess, e-commerce. It is the bread and butter of the business, and it's been a very interesting turnaround strategy that the company has pursued, because you think just a couple of years ago we were talking about splitting off the empire and listing these 6 different business units. They've been under new management, and it seems like that back to basics strategy has paid off, because we saw revenue for Taobao, Tmall picking up substantially. That came in at just 4.8%. It was expected to have risen around 2%, so a strong beat there. But the cloud division was the one that we tracked really in particular, because we saw very strong growth there for that, up 13%. It was the fastest pace we'd seen in 2 years, and really helped by what has been triple-digit growth in AI-related products. And executives are saying there's a lot more to come.
Yeah, especially when it comes to AI, right? And that shift that you mentioned from their traditional model. What can we expect in terms of artificial general intelligence as their primary objective?
Yeah, well, it's very ambitious. You could say that for a start, because I think we need to sort of caveat that with people would say AGI may never happen, or it could be decades away. But they're really putting it front and center for their objectives, and it sort of speaks to their broader AI focus as well. Because yes, cloud revenue, but as it stands, Alibaba is the only player in Chinese AI that builds its own models, it builds its own data centers, it runs a cloud service, and it funnels capital into AI startups like Moonshot, Minimax. I mean, it's got a suite of ones that it's invested in so far. And so it's a portfolio that's kind of similar to Microsoft. That's how you can kind of think of it. But yes, that is what the CEO Wu said on the call, that they do want to be able to build AGI. And again, it just speaks to that greater focus on AI moving forward.
I mean, we do have to wait for the market opens in Hong Kong, but so far overnight, investors like what they heard.
Yeah, we saw a strong market reaction. I don't know if we can say good, but we saw it moving higher. Essentially, it closed up around 8%. It's been, yesterday, Mark Ramfield from our MLive team had a really good way of putting it. He said that NVIDIA's earnings are like NVIDIA, right? Alibaba's earnings are like the NVIDIA for the Hang Seng. That's how important it's going to be for general market sentiment in Asia today. So it'll be really interesting to watch how trading starts in China, and whether, just taking a look at the Nikkei down fairly flat right now, interesting if it starts to turn sentiment around a little bit. But we actually have as well seen some interesting investors moving in or continuing to build up their stockpiles as well. We've got Cohen, for instance, a known meme stock king. He's now boosted his stake to around $1 billion. That's what the Wall Street Journal was reporting. But people are quite bullish on Alibaba.
Yeah, the fact that they gained about $100 billion of market value just this year, that's incredible. Annabelle Jewelers here with the latest of Alibaba as we head towards that market open in Hong Kong. This is Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Sorry.
My voice and my conversation, my poetry, you know.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This Sunday, Germany heads to the polls following the collapse of Chancellor Scholz's coalition. With the focus on the economy, migration, and geopolitical tensions, how will the German balance of power shift? Bloomberg Television has continuing coverage leading up to the election and will bring you the results after the votes are tallied with a special post-election broadcast. Tune in Sunday, starting at 5 p.m. London time. Only on Bloomberg. Context changes everything.
I do have my first call with my Chinese counterpart tomorrow morning, so I look forward to a very productive discussion.
What's the first point you want to bring up?
That we want to work together, and as we said, a lot of the precursor ingredients from fentanyl originate in China, so we really want to put a stop to that very quickly.
U.S. Treasury Secretary Scott Bessent speaking to Bloomberg Surveillance. Bessent also repeating that China needs to rebalance its economy ahead of that phone call on Friday. For more, let's bring in our China correspondent, Mimi. So what more can we expect from that call?
So Bessent was saying that the only agenda on this call is fentanyl, but whether he will make progress on that call is a big question because the Chinese embassy in the U.S. has said that China already has given a tremendous assistance to the U.S. on this issue. And yes, granted, China has already taken steps to close the loopholes, to strengthen supervision when it comes to fentanyl. They have also given U.S. officials, law enforcement officials, a greater role when it comes to investigating these smuggling rings in China. Some of that effort has been halted when ties soured, but they were restarted at the late stage of Biden's administration. But clearly, Trump administration is saying that that is not enough. And Trump has said in his executive order, it was written there, that the U.S. believes China has the most sophisticated surveillance mechanism in the world and a very strong law enforcement mechanism. So if they so choose to, they would be able to put an end to this fentanyl crisis. So both sides have very different starting points here. Whether they could come to a compromise, that's something that we have to keep a watch on.
Yeah, and of course that has big implications when it comes to tariff negotiations.
Yes, as you heard there, Scott Bessent also mentioned the imbalanced economy. He's reiterated that point several times, saying that China has the most imbalanced economy in the history of the world and that China is exporting its way out of recession. His words, not mine. But Trump has signaled that he is willing to cut a deal with China, but no details on the shape and form of that. And so far, based on China's very carefully calibrated retaliation that has been seen as largely being less proportionate to the scale of the U.S. tariffs, there is signal that China wants to tone this down as well. But you add to that the question of whether these tariffs are an end in themselves to raise revenue for the U.S. in lieu of tax cuts. Plus, you throw in Ukraine into the mix. Does Trump require Xi's help to end that war, to help with reconstruction effort post-war? Or does a leaning towards Putin from Trump, does it come at the expense of Xi, because it at the same time would refocus the entire attention of the U.S. military to China and its alleged aggression in the South China Sea, to the Taiwan issue? Remember that the State Department recently removed a phrase that says the U.S. does not support Taiwan independence. That phrase had been removed from a fact sheet, although the U.S. outwardly still say they support the One China policy. So many moving parts here. And again, we just have to stay tuned for how those negotiations go.
Bloomberg's China correspondent Min Min Lo there, taking a look at some of the other geopolitical stories that we're following. And Scott Bessent also signalled that sanctions relief for Russia could be on the table in talks over the war in Ukraine. The Treasury Secretary told Bloomberg that Washington is prepared to either ramp up or take down penalties based on the Kremlin's willingness to negotiate. Bessent also criticised the Ukrainian President Vladimir Zelenski for suggesting that President Trump is misinformed about the war.
A lot of his remarks in Munich I thought were inappropriate. President Zelensky, when I met with him, assured me that he'd be signing the minerals deal in Munich. He has not. And look, the real purpose here, and I think it's turned into kind of this media circus, that President Trump had a very elegant plan.
South Korea is seeking to implement tariffs on some Chinese steel products due to concerns over an influx of cheaper products flooding the market. The proposal includes a provisional tariff of up to 38% on hot-rolled steel plates imported from China. The levies will take effect once approved by the Finance Ministry. Hong Kong's oldest pro-democracy party will call a vote on whether to dissolve. The Democratic Party's chairman says a committee will work out a timeline for the process. He says the move is based on their understanding of the current political situation. The party was founded in 1994 and was among the city's leading opposition forces before Beijing's national security crackdown on dissent. Well, Germans head into a crucial national election on Sunday with an economy at breaking point. After a campaign that's exposed deep divisions on issues including immigration, Bloomberg Originals has been taking a closer look at what's polarising voters. Here's a preview.
For decades, Germany meant heavy industry, exports, mining, a rock-solid bond market, and reliable, steady growth.
The idea of post-war Germany was built to a large extent around economic well-being and prosperity. That prosperity promise has failed and disintegrated.
Since 1950, Germany's economic story has been one of year-on-year growth, or it mostly has if we ignore COVID, the financial crisis, and some one-time blips. Only twice in this period has Germany's economy contracted during consecutive years, once between 2003 and 4, and just now. And while these yellow bars show a tiny bit of forecasted growth, even that's already been revised down. And since the financial crisis, Germany's had strict limits on how much additional borrowing the federal government can take on, equal to 0.35% of GDP. Or put another way, the smaller the economy, the less new debt available to put towards stimulating it.
Subscribers can watch that report in full on the terminal or on our website. It will also be posted later on the Bloomberg Originals YouTube channel. Do join us this Sunday for special live coverage of Germany's elections here on Bloomberg Television. Take a look at how futures in Europe are opening up at the moment. And this is a picture, as we saw in the previous session, stocks in Europe dropping as investors really weighing the impact of earnings as well as the talks over Ukraine. Some European companies did report stronger earnings, Schneider Electric, for example, but there were some disappointments as well, in particular from Airbus and Carrefour. German DAX futures looking a little bit negative as we get that risk aversion ahead of that weekend vote, but we have seen some analysis suggesting that any post-election rally in German stocks could benefit those mid-caps more than the broader DAX. You see that huge gap really beginning to close between the two indexes there. Well, more ahead on the Asia trade, this is Bloomberg.
Up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Kuala Lumpur. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
I'm David Weston. Join me for the next generation of Wall Street Week. This week, countries and companies trying to sort out what the growing range of tariffs President Trump promises will mean for them. Plus, Vice President Vance tells the world the U.S. will lead in artificial intelligence, but there are some hurdles to get there. And Germany heads into an election this weekend, with change in the wind.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Well, mining giant Fortescue says it's still optimistic about China despite seeing softer iron ore demand. CEO Dino Otranto told us exclusively about why rising trade tensions as well are not much of a concern for their business.
We've been in China since we started, more than 20 years, and we take a mid to long-term view, and certainly the fundamentals of China are amazing, really. 5.5% GDP last year on a much, much bigger base. And we're seeing the government really step in to make sure that that property sector is supported, coupled with the diversification that we've seen over the last 5 years into higher-end products, and the automotive industry can speak for itself, and it's consuming a lot of steel. So we're really excited, actually, about China.
But then how do you layer in the tariff story? Because Donald Trump says it will be possible to reach a fresh trade deal with China, but then you've still got the 25% steel tariffs to factor in. So how do you plan around all of that?
Yeah, so we call it Trump version 1, the first time around with China, and we've seen China really respond structurally to diversify around its exposure to the US. So we believe the tariff situation, wherever it may land, it's early days, is not that much of a concern, particularly for our products, which have a high degree of liquidity going into China.
Fortescue CEO Dino Otranto speaking exclusively to Bloomberg in London. Take a look at broader commodities right now, because we are looking at iron ore, which was pressured throughout the week. We had seen major miners, including Rio Tinto and Vale, posting declines in earnings, and prices fell. Of course, we continue to watch China's property crisis and just demand concerns overall. We had copper closing slightly higher in the London session. We continue to see the broader metals market as we are headed head towards those tariffs on aluminum and steel. Oil set for weekly advance. Supply uncertainty also clouding the broader outlook there. WTI up 0.2%. This is Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Names that move markets are on Bloomberg.
Has your staff tried to block any payments here at Treasury?
We have not. Elon and I are completely aligned in terms of cutting waste and increasing accountability and transparency for the American people. I believe that this DOGE program in my adult life is one of the most important audits of government or changes to government structure we have seen.
Nobody covers business like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Order partially filled. Order partially filled.
We're getting PMI numbers out of Japan. The preliminary data for February, the composite 51.6, above that expansionary territory for the number, and this is for a fourth consecutive month. When it comes to the manufacturing PMI, 48.9. We've been in contractionary territory since July of last year. Services PMI 53.1, improving slightly from the previous month. Of course, earlier today, we had seen the CPI numbers, headline inflation accelerating to 4% in January, the highest in 2 years. And you can see right now the Nikkei under pressure, 0.2% as the Japanese yen continues to trade around that 149 level, paring back some of those earlier gains, but still at the strongest level since around December. Let's get more on the outlook for Japan's economy and the BOJ's rate path. Bloomberg senior Japan economist Taro Kimura joins us now. Taro, interesting the Japanese yen reaction to the CPI data, because the number was pretty strong, but was it broadly in line with expectations?
Right. The trick for Japan's CPI data is the move is almost predictable from the Tokyo's CPI data that was disclosed a few weeks earlier. So I think just investors were relieved that, the national print just followed what we observed in the CPI. So therefore, there wasn't a lot of move in the market right now, I guess. But at the same time, it's true that, the January CPI print is really hot, particularly with the food prices. And when you're living in Japan, you can feel in the daily lives the food is getting more expensive, which spill over to services such as dining out fees like, sushi, pork cutlet meals, gyudons, which is actually a CPI items in the data. So I think the BOJ is alert to a spike in food prices spill over to broader items.
How do you feel about the momentum when it comes to the Japanese economy at the moment, if you take a look at the most recent indicators?
Right. The various indicators point to strength of recent Japanese economy's momentum. For example, the wage data, not just because of the strong base pay rises due to a Shunto negotiation, but also the stronger winter bonuses surely bolsters the income, which do spill over to recent private consumption in Japan, which was part of the reason that the fourth quarter GDP data surprised the market. And regarding the wage data, more is coming and the inflation is getting hot. So therefore, we think the deflation or disinflation is now history in Japan and the economy is getting normalized. Therefore, that will give BOJ more reasons and leeway to normalize policy further.
Is that the reason why every time we get BOJ commentary these days, they sound a bit more hawkish, perhaps even no concerns about rising yields at least, which could potentially point to this tightening path that we seem to be on very firmly at this point?
Right. I think the baseline message from the BOJ is, hey, economy is getting healthy and we have enough inflation. The yields are too low compared that, given that inflation is above 2% and the current policy rate is 0.5%, so it's still negative in real terms. So the BOJ also now officially alerts to the concern that they're stimulating the economy too much. For example, the quoting, the rise in the real estate prices, as well as the possibility of making the life of zombie firms longer. Those are actually said by one or more board members officially. So therefore, I think what the BOJ is thinking about the bottom line is it's healthier for the economy to have higher yields.
Our senior Japan economist Tara Kimura there. Take a look at how Asian markets are tracking. We're just about 35 minutes into the start of trading in Japan and in Korea, and an hour and a half here into the session in Australia. We are seeing the Nikkei 225 a little bit softer, about 0.2% there. We are seeing some strong gains when it comes to healthcare, utilities, energy also gaining as we look for another weekly gain for crude prices. But tech, industrials, consumer stocks seeing some weakness so far in the session. The Kospi also seeing some modest losses. Here in Australia, we're seeing a turnaround after a few difficult sessions of downsides as we have really some of that leadership coming through from banking stocks as well as mining staging a recovery after a series of pretty difficult earnings as well. Well, the Deputy Governor of Australia's central bank says policymakers are still rigorously focused on inflation, although no single piece of data can trigger a rate move. Andrew Hauser spoke with us after the RBA cut its key rate this week for the first time in 4 years, but did try to strike a hawkish tone on future easing.
There's been a great deal of positive news about inflation in Australia. Just to remind you, and you know this, we adopted a somewhat different strategy to tackling the inflation spike in Australia to other countries. We raised interest rates to a level we thought that were restrictive, but we didn't raise them to the sorts of levels that other central banks had done, precisely because we wanted to protect the gains in the labour market. And as I think you've been talking about earlier, labour data out show that the labour market in Australia has been incredibly strong, but inflation has also come down as well. What we said in December is that we would form a view about whether we become sufficiently confident that inflation would come sustainably back to target, to the midpoint of the target, 2.5, to begin easing. We did reach that position of sufficient confidence, but this is not a done deal yet. The underlying rate of inflation is still 3.2%, which is slightly above the band. The headline rate of inflation is in the band. And so although we've removed some of the restrictiveness that we had in policy, there is still restrictiveness in the system, and we still need to see a bit more good news on inflation coming back to that midpoint.
And the jobs data was quite nuanced, right? Because even though unemployment ticked up, even though we saw more jobs than expected, full-time being added. Participation still really high. The wages data this week showed, further slowing. Does that tell you that some of that robustness might start to fade in the coming months?
Which bit of it shows you that it might fade?
That we're starting to see the signs of perhaps a little bit more vulnerability in the labour market. And of course, Australia's not the only one that's kind of dealing with that scenario.
It's quite hard to see bad news in the latest employment data. They remain very strong. I think the debate about the labour market is a slightly different one, which is, although we know employment has been growing strongly, inflation has been coming down. And as you say, wage inflation has been coming down too. And so there's a very lively debate about whether that employment growth leaves us with less capacity in the labour market or a bit more. If there is a bit more, then inflation will come down more quickly than we're predicting, and that'll be good news because it would mean that we can adjust policy more rapidly. But we need to see more information on that, I think, before we can be sure.
What do you see as the biggest risks facing the economy?
Anyone who tells you they know how this is all going to shake down in the long run is wrong, right? We're all learning. Things are moving very quickly. I think one of the important points I'd say is actually that very uncertainty about trade policy and about outcomes in general, globally, not exclusively in Australia, may itself have an effect on activity in Australia.